All right, welcome to the lecture on auditing the revenue cycle. The main accounts in the revenue cycle are sales and accounts receivable. Of course, you can also have cash sales, so that's also a key account. You could have discounts and returns and allowances if the customer decides to return a product. You also have customers that won't pay, so you've got to keep track of that allowance for doubtful accounts and that bad debt expense that's out there. You'll have post-sale things you have to worry about, like warranties, and in case there's some difficulties with your product and there need to be correction made, you'll record that liability or that expense. You also have sales reps who want their commission on those sales, so that's something you'll keep track of. But there's other accounts besides these that you have to remember also. Like if it's a merchandising company, you're going to have inventory and cost of goods sold being affected, so that's important to keep in the scope of our revenue cycle. There's also going to be rebates potentially if you have agreements and contracts out there that if customers meet certain quantity levels of purchases, they might get a retroactive discount on their previous purchases. So that's something you have to keep track of. I've also highlighted here in red the accounts receivable subsidiary ledger. It's important to know that that's not an account, that's just the detail behind the accounts receivable. So that ledger just shows all the different customers and all the balances that they have out there for the different transactions. That when you roll that number up, it becomes your accounts receivable number. It's important to have that subsidiary ledger out there because it helps us identify doubtful accounts that are out there when we use our aging report, which we'll get into later on in this lecture. But that kind of sums up the majority of the accounts in the revenue cycle. The little twist for today is we're going to do some processes through QuickBooks so you can actually see them used. Now, this QuickBooks process flow you'll see when you open up QuickBooks, and it's just one of about 3 different ways you can get to different areas of QuickBooks. Many ways to do things within QuickBooks, but you can actually select these icons. You'll see related to customers, and usually the revenue cycle is this. It usually starts out with a sales order that you're creating, but that's usually generated by the customer giving you some sort of purchase order to create that sales order. And you'll see in the flow that if you don't have the product, you may have to order it from a vendor, and you'll put a purchase out order out to a vendor. But you ultimately may have the product, you use that project, you create invoices, you receive payments, all the basic processes that you'd have in the accounting end of QuickBooks are reflected here in their flow chart, and we're going to do some of those transactions. All right, the start of this revenue cycle process includes our customer order sending us a purchase order so that we'll have this customer order and create a sales order with it. So we've got Euro Toys Limited, who has sent us a purchase order for 50 packages of Tartingas. So we're going to be shipping these items out to Euro Toys in London, UK. We've entered our sales order information there, and eventually we'll invoice them $1,750 when the order is complete. So from an audit perspective, you've got a sales order that you've generated, but just to verify that, you might want to look at the purchase order that was received by your client that you're auditing. But there's always some important things that need to be done behind the scenes in the setup mode, and we're going to talk about a couple of those areas. The first one is related to our customer setup in the master data we have for Euro Toys Limited. We need to have a credit limit in there, and that's part of our controls to make sure that they don't exceed that. So they actually have a $10,000 credit limit, and we've got them set up to pay in 30 days. They've got their account number, and so this is what we would have as master data for our customer Euro Toys. So if we were to go into that sales order and type in 1,000 ordered units, let's say we misunderstood it and put in 1,000 units, as you'll see there, we might get this error message that says, hey, this exceeds their $10,000 credit limit. Now, this is what's called a soft stop. A soft stop means we've put this in the system. It allows us to say, do you still want to continue? Yes. Most systems will have what's called a hard stop, which means you can't continue with this order until it's fixed or below the 10,000, or you go to the credit manager and he increases that credit limit from $10,000 up to over the $33,000 that order would value. So that's a kind of behind the scenes control that's in place to prevent someone from shipping out products in excess to a particular customer by using credit limits.